Afternoon, everyone. I'm delighted to welcome you all to the first webinar of a series of 4 on financial management for social entrepreneurs. We have 4 steps and one webinar corresponding to each step. I'm Luísa Ferreira, and I'm the head of the social program at European Investment Bank Institute, and I will be your host for today's webinar. The webinar is part of a series of webinars we have been designing principally for the Social Innovation Tournament alumni, but are open, in fact, to all change makers interested in these topics. It's my pleasure to introduce you to Thomas Ferré, that will be your presenter in the 4 sessions. I'm very grateful to you, Thomas, for having accepted our invitation. Thomas works at the European Investment Fund Mandate Management Equity Team, but in addition, he is a former social entrepreneur himself with a previous career in venture capital. I truly cannot think of anyone better to answer any questions you may have on understanding debt versus equity or your capital structure as a social entrepreneur looking to raise funds. Throughout these 4 sessions, he will also walk you through the main steps to value your company and offer you insight on how often you should raise capital. Thomas, Thomas, to start the webinar. Thomas, the mic is yours. Thank you.
Good afternoon, everybody. So my name is Thomas, and I work with the EIF. Just as Luisa, thank you for the invitation, and Denise, thank you for coordinating everything. As I work in the equity team at EIF. My background, I've been helping companies grow for about over 15 years, since the early 2000s. I've been a VC and a growth investor around the world. I've invested and sold and managed companies on 4 continents. And I was also a social entrepreneur, having a circular economy company. In fact, I was one of the earlier founder of a fully circular company. So we have 4 webinars, and each of these webinars is going to last about 40 minutes. In a 40-minute webinar, you're not going to find the truth that's going to make your business a $1 billion business or €1 billion business. You're going to find ideas, important concepts to dig into. So I really encourage you to take the opportunity of these webinars to find concepts that you're unfamiliar with that I'm going to be presenting to you, and then dig deeper into those concepts on your own, or also reach out. Who is this webinar addressed to? This webinar is addressed to entrepreneurs, entrepreneurs who are in the process of fundraising, about to fundraise, wondering how they should raise capital, how it affects their company, and what implications. So with that said, let's start today. Today is we're going to go over a basic understanding of the capital structure. Now this part is quite important to talk about before we talk about business fundraising and valuation. So this is the reason why today we're going to be talking about what is debt, what is equity, how VC investors look at investing, and how you might look at debt and equity given the risks that they represent to you and the opportunities that they represent to you as well. So if you look at this new slide, basic understanding of the capital structure, let's say if you only had a couple of minutes as part of this webinar and had to jet off to another place or another call or meeting, this is the slide that you would be taking away with you. It gives you some of the key terms that you'll have to focus on and the key concepts that you want to be researching later. So first of all, creating a company is risky, and its success is tied to the ability to be financed. So financial preparedness is essential. Every entrepreneur, when they think about their business, they'll put together a an Excel model that essentially details the growth of their business, and that's really an income statement or a cash flow statement. One part of your financial statement that's overlooked is your balance sheet. And so your balance sheet details what your assets are, what your debt and your equity are. And in summary, the debt is a source of funding that limits risks for its investors, is cheaper for you, the founder, but it increases bad time risks for you, the founder. Equity uh, is a source of funding that maximizes returns for its investors, and so is more expensive for you, founders, but it also limits the bad times risks that you might have as a founder. And why are these two important to look at is because um, essentially venture capital investing is about investing um, for return in highly risky businesses. And so venture funding combines a lot of debt features in an equity format. And then finally, we're going to make some reference to the cap table and distribution waterfall that are an essential part of the calculations you need to put together as you build your balance sheet and your equity ownership table. So now let's look at the next slide, the importance of being prepared. In this slide, you have two pictures. On the left, you have a woman who's starting a business, who's really interested in what goes behind my business, what am I going to put together. And on the right side, you have two skydivers, one with a camera taking a picture, and the other one that has no parachute. And according to you, who are the people that are taking the most risk here? I'm going to let you a couple of minutes to think about it, a couple seconds. Now, when we think about risk, we obviously think about outcomes. So clearly, the skydiver is if everything goes bad, he dies, and the business owner, if everything goes bad, then she just declares bankruptcy for her business, and then she goes on with her life. But setting that aside, if you look at the skydivers, they have a death rate of 6 deaths per million jump. That's incredibly low. On the other hand, back to the left side, the startup death rate is 80 startups fail. Over 80 startups fail per 100 startup having fundraised. And so that's very important for you to understand that there's an incredible amount of risk in creating a company, and that risk is an important consideration for all of your investors. So that's why I'm starting with this slide. It's really to make you understand the risk that an investor is going to look at when he's going to look at your company. And by the way, I'm just making a side point. Although you already know what your success will look like if you succeed, and that's what you're working on through your business plan, saying, if I'm successful, here's what it looks like. But it's also very important to know what failure looks like, if only to understand the mistakes that other people have done, but to also understand perhaps when is it time to pull the plug on your side. And there's a website, CB Insight I'm putting the link here, has great insights into hundreds of startup failures. So I really recommend that you look at them. That's one of the tips of mine that I'll give you today. Now, moving on to the next slide, we've talked about a risk that an entrepreneur takes, and here you'll see it in numbers. So on the left table, you'll see the failure to exit percentage over a panel of 35,000 companies, startups between 1990 and 2010 per series. So imagine that if you raised a Series G, which is very, very late in the development of a company, you might have a 70%, over 70% failure to exit. Now, where does all this come from? Well, if we look at the top 7 reasons, there's a couple of lessons that this picture gives us. First of all, only one of the 7 reasons is outside of your control. Get outcompeted is the number 4. And I'll take an example of this. So it's a startup that hasn't failed yet. But I'll just give you an example of what it is to be outcompeted. So it's a startup in the Netherlands that does charging stations for electric vehicles. And this company is worth about over 150 million euros at the time when we're talking. And they have over 100 charging stations in the Netherlands and a little bit in Germany. About 6 months ago, Total, the energy company, won an award of 20,000 station in the Netherlands. So if we use the valuation of that Dutch company on a euro per charging station, that's about 150, that's 1.5 million euro of valuation for every charging station. That would represent 20, if we use that valuation and apply it to Total, that would represent about 20% of Total's valuation. But if you look at any investor, they wouldn't consider it to be perhaps even 100th of Total's valuation. And so that gives you a sense of discrepancies in valuation, but it also gives you a sense of the importance of how quickly you can be outcompeted. That point set aside, I want to go back to the points of in our topic. All the other points, the 6 points, are matters in your hand. No market needs, how well do you know your market? Run out of cash is how well you manage your financials. Not the right team, that's really how you put your team together, how people fit, and how they're able to look at what's important for the company versus what's important for them. Reason number 5, pricing and cost issues. That's really about also how you understand your financials. User-friendly product, that's also a big consideration, but that's really on the product design side, so we'll leave it aside. And then the third reason out of the top 7 that relates to financial management is product without a business model. And so 17% of startups fail because of this is one of the reasons for 17% of startup failures. So I think this is very interesting, and the main message here is financial preparedness is extremely important. So your ability to understand your financial model, your accounting, how your business is represented, how it represents your business, and how you manage it will have a huge determining factor in the success or in prolonging the life of your company. Now, if we move to next slide, what goes into business, this is where we go a little bit into the balance sheet a little bit deeper. So let's assume you're a business owner, and I'm going to use a very simple business idea or business type as a comparative standpoint for your business. So you might have a SaaS company that's entirely software. You might have a consumer good company. You might have a high CapEx company, but they all in a way relate to a house. And the reason why I use a house is because its balance sheet is one of the most standard balance sheets you can have in the world today. Now, your balance sheet is composed of assets and liability and equity. On the left side, assets are practical things. They have an economic value and they make your business generate revenue. So in the case when you build a house, you'll have raw materials, concrete, piping, etc. All of these things are going to contribute to building your house. Glass, but you also have yet to be paid sales receipt issued by the company. You'll have perhaps intellectual property, you'll have finished goods, you'll have computers. You have a whole number of things. These are assets, and that constitutes the left part, if you will, of your balance sheet. The asset is equal to the sum. So the assets are essentially the use of your funding, how you use your funding, and the right side is your liability and equity. And these are the sources of funding that you use to help your business grow and to help finance your assets. The more senior part, which is the first one that gets repaid, is the debt and your liabilities. So debt liabilities, also another word which includes debt, is funding the company is required to pay back. So examples, billing, it might be short-term debts, long-term borrowing, for example, in the case of a house, a mortgage, 30-year loan, that's long-term debt. It might be asset-backed in the case of a house. You're borrowing against the value of your house as a mortgage. It's rather standard, so that will be again that will be backed by your house, which means that if you can't pay your bills to the bank, then they'll seize the property, they'll seize the house, and then they'll try to get money out of it. It might be your debt might be unsecured against your operating profit that you make out of a house, for example. And now on the equity side, equity is the funding the company gives its profit and residual claims to after having repaid its debt. So what exactly is this? This is where you put your profit in the form of retained earnings, or you pay dividends. So essentially when you pay dividends, you take profit and send it to your shareholders. So they own equity and they get the dividend. And so that's really the part where if your company grows, it grows with you. If your company loses money, then it'll lose equity. This is the variable part of your funding. Now let's move a little bit deeper into debt and equity. So next slide, what you see on the top is debt, and what you see at the bottom is equity, and it's generally represented like this because debt is the senior part of your funding sources, and equity is the junior part of your equity funding sources. And the reason that is because debt it gets repaid before, again, and equity gets repaid later. So when you're a debt investor, how do investors look at debt and equity? When you're a debt investor, you're here, say, I'm willing to invest in this business, but I really want to minimize my risk. I want to make sure that I'll have perhaps a fixed repayment schedule, that I'll have priority in the repayment of my interest plus of my return plus my principal. That might take place through a priority repayment schedule or liquidation preference in the agreement of your debt funding. I've talked about it. There's different types of debt. It might be asset-backed, secured by an asset, in which case they'll say, in a bad scenario where we have to seize the property to get repaid our principal, what would be the value of our asset? So they'll look at this and they'll lend against that discounted value of your asset. Or they can lend in an unsecured way against your operating profit or EBITDA. The debt investors will not share the upside of your business or the downside either. They don't really care about that. They're here just to make sure that they have a stable, certain, and low risk return. And so lenders expect typically, because of their seniority in the small risk that they take, they typically expect a return of 2 to 15%, let's say, per year. It can go much higher than this if, for example, if you have a credit card might charge you as much as 30 or 45% interest rate. That's considered debt. Equity on the other side is equity investors are here to maximize their return. They're saying, I see this business, I see risk certainly, but I want a part of the upside. If I'm putting money in there, I feel like if it's going to fail, it's going to fail completely. So there's no point in putting debt in there because I don't believe in that thesis. I want to maximize my return. I'm putting money in that business because I feel like it's going to generate a lot more return. And because of that, equity investors expect a higher return, so 8 to 35%. I'll talk a little bit about that in just a few seconds. Equity investors, they share profit, they share equity, they share valuation growth upside, but they also share the downside. So equity investors are really aligned with you. And so they're going to be the ones that are most active in saying, how can I help? But they're also going to be the ones that are going to be quite active in saying, oh, things aren't doing well. What do we need to do? What kind of tough decision do we need to take now? So they're going to be quite present because they're sharing the upside and the downside. And that part of the decision making is something that you have to understand where you're going to be raising money. How much do I want people to be giving me advices at every board meeting, at every shareholder meeting, or perhaps more frequently, if that's the case? Well, that's really something you have to take in consideration. So they expect a return of 8 to 35%. I'm just going to talk a little bit about this more. I'm going to talk more about VC returns expectation in the second webinar next week, where we're going to try to go behind the 35%, but at least the 8%. The S&P 500, which is an index of companies in the US, has returned 8% for 100, 150 years. And so investors have taken this as a benchmark of saying, well, at a minimum, equity should return 8%, and so that's the reason why. Okay, let's move on to next slide. So this previous slide was about risk and return for investors, how they're looking at it. Now, how should you look at it? You already need to understand the concepts of risk and return for investors. Now let's understand the concept of risk and return for founders that are raising capital. Now let's assume you've got a business that needs 100 of investment. We're going to look here at three scenarios. In the first one, you're going to invest 100 of equity as a founder. In the second one, you're going to have 50 of equity and then 50 of debt. And then in the third one, for example, in the case of a house, you might put 20% down and then borrow through mortgage 80% of your financing with a bank. So that's the 80-20 is a leverage of 4. The 50-50 is a leverage of 1. The concept of leverage is an important concept. Leverage happens when an investor, as a founder, uses borrowed money to increase its return. Borrowed money is the important term here. It's money you don't own. It's money that you don't have. So in a way, it's almost like virtual money. It's like you don't need to repay it off of your returns. You just need to repay it and that's it. So borrowed money gets repaid first. And because of that, it also increases downside risk. When things go bad, they have first say in how the business gets restructured. So let's look at the case of 30% return. When you have a 30% return and you have invested 100% equity in your business, then you get a 30% return on your 100 equity. That's fairly straightforward. In the case where you've levered 1-to-1 and you have 50 of debt, then your return of 30 is on the 50 that you brought as equity, and so that's a return of 60%. It's pretty cool. And it's even bigger when you get a return of 30 off of having only invested 20 because you took 80 in loans with the bank. And so in the case of a house, for example, if you buy a house, you borrow 80 versus your 20, and the market goes up, and all that upside is compared to your actual equity investment. If we leave aside, of course, all the interest that you have to repay. And so that's a 150% return. That's quite significant. Now, it's significant, but there's two sides to a story. Now let's look at the 30% loss scenario. So when you lose 30% and you're 100% owner of your business or 100% equity investor in your business, or have 100% of your business funded through equity, then everybody loses 30. So in the end, you only have 70 left. That's fairly standard. You don't owe anything to anybody still, and you just continue on about your business and try to get back to that 100 and higher. in equity. If you borrowed 50, then your 50 that you invested together as equity investors becomes 20. Now you're nearing, bankruptcy, and you lost minus 60%. That tells you that immediately the bank is going to start giving you a little bit more phone calls and try to understand how the market is going to see if they should be doing something. And if you were even more levered in the case on the right, well, at this point, you owe 10 to the bank, and the bank owes all of the 70 in the business. So at that point, in fact, a little bit earlier, the bank was able to essentially go to you and say, at this point, you're in bankruptcy. You can't pay me my interest. You're not going to pay me my principal. So I have first right to the business, its assets, and whatever claims I can have. So I'm stepping in. And usually, what CEOs and founders will do, they'll seek bankruptcy protection, and then they'll try to work things out with their lenders, because instead of just liquidating the business, there might be a better solution if you just work through it um, and implement a series of measures of cost cutting, profit maximization, a number of things that might help your business actually stay alive for a little bit and grow a little bit after. So a number of companies actually do this on a regular basis. Right now, some companies are doing that in the US. They were doing, some others were doing, airlines might have done that in the past, for example. And so, but essentially here, you're in the hands of your lenders, and your shareholders have very, very little say in anything that's going to happen. You could try to negotiate, but again, your bank at this point, your debt funders own the company. Now, now that we understand all of this, we understand what that is, what it represents to investors, what it represents to you. We understand where equity is, what it represents to investors, maximizing return, what it represents to you, having aligned investors and sharing in the downside, but also giving part of the upside. And considering the first point of this presentation, which was startups are very risky investments. Let's move on to the next slide, the next two slides, which are going to cover essentially the terms of investments of a VC. So VC invest in a highly risky business in an equity form. And so because of that, venture capital firms will invest in equity because they want to share the upside, but with debt features. So let's look at some of the key terms of these debt features. Well, first of all, I have to say, I'm going over those terms, but it's really here. There's links where you can find more information on both pages, including specific aspects of these terms. And I really, again, encourage you to use these slides as a starting point and then research them, talk to VCs, understand through other founders how they've raised money, how they looked at it. Go on Crunchbase, go on. There's a number of blogs going on VC blogs. They'll talk also about how they look at certain aspects of their term sheets and their investment documents. But let's at least go through at a high level what these are. So convertible notes. So convertible notes are short-term loans, typically less than 2 years, that will convert into equity under two scenarios, let's say, in most cases. One is either at a discount of the next valuation. When you really can't price a business, you're going to look at saying, well, I don't know what the value is. So I'll give you some money as an equity investor in a convertible loan, and then it'll convert at 20% of a discount of your next valuation. This way I know you're going to raise in the next year or two, and I have a 20% upside on my investment. So that's one way. Another way is to put perhaps a cap on the valuation. For example, investor A will give you 300,000 euros, and they'll say, this is a convertible note. Next time you raise money, my notes will convert, and they'll convert at a maximum of 3 million euros or a minimum of whatever valuation you have going on. So if you raise money at 5 million, then they'll convert their note into a shares at a 3 million valuation. If you raise money at 1.5, then they'll convert their shares at a 1.5 million valuation. Series, denomination, and class of shares. So each new class is considered a new round and has priority repayment features over previous investment rounds, but a much higher valuation. So essentially, they get repaid first because they have a smaller upside. So it's sort of that's a give and take, if you will. The series A, B, C, etc., all come generally in the form of preferred equity. Preferred equity means that you're able to establish some sort of liquidation preference, and they come with this third point, which is a return waterfall liquidation preference, which are very important to understand because they allow you to really understand the implication in terms of dilution, in terms of ownership, in terms of what happens when things go well or when things go bad, or how much of your company you're giving away for each round of company. And every round that you do, it gets a little bit more complex. There's a simple way through Excel to do it, and there's many videos and many resources that you can look at. And certainly we'll go over this in webinar number 2 next week. Let's move to the next page. Other investment terms that VCs will look at is preemption rights and rights of first refusal. So this priority, it establishes a priority. Existing investors have to buy new or existing shares, price matching the best offer, of course, that you might have in the market. So let's say you're raising a third round of money and you need 5 million, and you go to the market, and then your existing investors all have a preemption rights and right of first refusal, and they'll say, hey, go and raise money, and then you'll say, oh, we raise money at a valuation that's quite that's above theirs or below theirs, and if they have the ability to actually have a preemption right and right of first refusal, then they make sure that they won't get diluted through down rounds, or they won't they can participate in later rounds if they feel like it's worth it. The anti-dilution provisions, it's the ability to be or not be diluted in the case of a down round, or in other scenarios. So that's also important. Two other important concepts that are unusual for us, I guess, regular people to understand. One is tag along, and the other one is drag along. So tag along is essentially it gives the investors the ability to tag along the founder if the founder exits. So let's say you're the founder and you own, it doesn't matter, 50, 60% of the company, and or 80% or 30%. Essentially, this right it precludes you from exiting the company without existing investors, others investors having a say. You want to sell to someone who's saying, yeah, but I can only pay for your shares, and the investors will get very anxious because they don't want the founder, who might still be the CEO, to leave. And they'll say, well, if you're leaving, we're leaving also. We were aligned with you. We don't want to be part of this business, etc. They have a tag along, then you have to find a buyer that will buy all of the shares. Drag along is, on the other hand, if investors are saying, this business, we don't know where it's going to go, and we have a buyer for the entire company, and we know you don't want to exit, but we're going to use our drag along rights to make you exit, and so they can force you to exit, for example. And then voting rights, well, certainly we've talked about this a number of times. So let's move next so we've talked now about terms, we've talked about risk, reward, and now let's look at What does your balance sheet look like in a qualitative way after raising a number of rounds? Let's say you're now a growth company worth a couple of million euros. Maybe you've done 3 rounds, etc. Let's look at your balance sheet. So on the top, um, balance sheet always is structured in most senior on the top and most junior on the bottom. So on the top, the asset-backed debt, and this is the debt that goes against the existing assets in your company. Unsecured debt, I've also talked about it. You might get lending loans based on just your financial performance. If you're a SaaS company, you don't have necessarily a lot of capital expenditures, but you might say, you know what, I'm generating a lot of operational profit. I might be able to borrow against that, and then the bank will say, or a lender will say, you know what, I like your business. You're stable. You're doing well. You're growing well. I'll lend you some money, but I want to make sure that you can repay me. So perhaps they'll look at a typical standard ratio, which is the EBITDA coverage, interest coverage ratio, and they'll say, you know, we want to make sure your operational profit or EBITDA covers 3 times the interest that we're going to charge you. So they're going to calculate how much they can lend you like that. Now let's go on the equity side. Um, so this, as I mentioned earlier, the most senior equity tranche is the first to be repaid, including an interest sometimes. If things go well, they get the smallest return, obviously, because they came in at the highest valuation. And then as you go down all the way to Series A and seed equity. Uh, a seed might come in the form of a convertible note. Series A will come in the form of a preferred return. It will be senior to seed and common. And now the founder's equity is the more junior equity. It's typically common shares, and they're last that get repaid. And they're, of course, the ones that get the biggest return. So having said all that, what does it mean to you, the founder? Let's recap a little bit all of the lessons of today. And let's take them into the context of where we're going next time. This session today was really the starting point of getting to talk about valuation. When we talk about valuation, it means that we're trying to negotiate, see how much our company's worth on the equity side. Um, and when we talk about valuation, we need to first understand what goes into the valuation, what consideration investors will have, if we just fundraise just equity or debt plus equity or just debt. And so before talking about valuation, we needed to talk about debt and equity and what they represent. So founders need to be careful and to do careful planning before raising debt and equity. And you need to understand the implications for good and bad times. One of the big elements that you need to consider is how is the investor going to react when things go bad? Are they going to be putting a lot more stress on you, or are they going to be trying to help you find a good solution? Good investors help you in the bad times. The second point is VCs are return maximizers and risk minimizers. So they invest in a business with an over 80% failure rate, and their approach is entirely about how do I maximize my return and minimize my risk. So that's obviously justified on their end. And that really requires, because companies such as at an early stage, your company at such an early stage, really requires a lot of legal terms. So one tip here is make sure you have um, a good understanding, a good lawyer, a cheap lawyer, but a really good lawyer that'll do a really good job at putting your documents together. Bad lawyers will do a bad job, and you're going to feel it every single round throughout your fundraisers. Third point, integrating the cap table, understanding it, and mastering the distribution waterfall in the business plan is an essential part of the financial preparedness and the fundraising process. That's very important. Balance sheets and cap tables are overlooked. You really need to understand them. And then the final part, a lot of information is available online. So really use this webinar as a starting point and explore the knowledge of the web to dig deeper. In fact, one thing, if we just go back to the slide before, about what sources of funding can look like, there's a big tip that I forgot to mention earlier. One is go and check. So think about what industry you're in, and go and check companies that are listed companies in the U.S. that are in that industry, and try to look at their balance sheet. Try to look at what kind of funding on the equity side, what kind of funding on the debt side, what kind of companies IPO'd recently, and then you'll have more insight. All these companies listed in the US, they have a pretty tough requirement in terms of reporting. And so, in a document that's called a 10K, which is a very long document that goes over all of the business activities, you'll find a lot of super useful information. Another really good source of information is Crunchbase, that'll tell you for many companies what kind of funding, how much they raised for seed, Series A, etc., the timing between those rounds, etc. So it's very useful. Both Yahoo Finance will give you publicly listed companies, and Crunchbase, which will give you startup information. And so, if having made that point about just public information available, having summarized our presentation, um, where do we go from there? And so, in this last slide, um, I guess you're left wondering, how do you value? We've talked about equity, we've talked about debt, so let's get ready. Now, how do you value your company for a venture round? Valuing a company is not easy. Perhaps you don't have revenues, perhaps you don't have profits. How do you value a company? And also, Thomas, you've talked about cap table through this whole presentation. Can we go through cap table with you? And can you give us more details on about how often I should raise capital, etc.? All these questions are great questions. I'm going to answer some of them in the next few minutes. But most of these questions that I've outlined.
Thank you so much, Thomas. And there was a problem with the sound, but now everything is solved. So I would like to start with the first question of the questions received, and one which is for you. What is your opinion on public funding versus investor funding?
And I'm going to answer it quickly. Public funding, so very rarely you'll find oftentimes you'll find it in debt form or grants. So I'm only going to talk about the equity form because the point of equity is a bit more peculiar and there's a lot more implication. And my answer is this one. It's a very simple one. You raise money from either the only people who will invest in you, practically speaking, or from the people who will add value to your business. So when you raise money at an early stage, you're not just looking for money, you're looking for people who are a little in the downside and who are going to be able to work with you if things go bad and help you find clients, help you develop your product, etc. And so that's really my advice. If this is a public investor, then great. If it's a private investor, then great. But you should expect your investor to be aligned with you in the good and the bad side. And so really make sure that you're getting your money's worth, because you're giving away money when you're raising money, when you're raising funds. You're getting your money's worth of soft investments from your investors.
Thank you, Thomas. I have another question, which is, how do you manage employee stock ownership? And if you can talk a little bit about the problem of cooperative enterprises where the capital, the majority of the capital is held by the employees.
Question. It's hard for me to answer this question, which is quite large, in a 2-minute way. I really encourage you in this page that I'm featuring on the presentation. There's a few links for ESOP, where you look at essentially how you create it, how you make sure it stays, or how it gets diluted, what it's for. I will say this at a high level. So ESOP are different than a cooperative where a lot of owners are invested. A VC will come and will want to have decision-making power. If
the decision is diluted through a number of owners that to make fast decision. And so I would really consider or encourage you to think about how many owners are in your business. Is that helping to make fast decisions, or is that inherently part of the culture of the company where it's a democratic process, everybody has to be on board before making decisions about at board meetings, etc., about how the company is going to go. And in that case, it's a different business, and in that case, it's a different investor who's aligned and who's interested in being part of this. These are small investors, not VCs. VCs will want to have strong founders, strong investors, and ability to move fast. And regarding ESOP, I mentioned a little bit at the beginning. So ESOP have 5 to 10% of your company, let's say, that you establish at around seed or Series A round, and then either you keep it through time by integrating it in your valuation as you raise more money, or you let it be diluted through the series, through a series of fundraising. And in that case, it's very well covered. I really encourage you to look at the math behind it and how to calculate it. But typically, 5 to 10% of ESOP is a good number.
We have many questions. I'm not sure we'll have time to go through all of them, so I'm shooting the next one, which is whether we have some tips about the capital structure for a startup that works with the R&D about waste treatment.
So that's I'm coming back to of the house. Example, the page right after the one of the house. So capital intensive, you should be able to borrow against your asset, and you should be able to borrow. The banker will come in and say, well, you know, what kind of machinery you have. So waste management, I'm assuming that this is capital intensive. There's waste management solutions that are not very capital intensive, that is essentially just about selling a product that allows waste management, let's say at the house level. And so perhaps you have a manufacturer that helps you manufacturing it, in which case is just another consumer business, if you will. You can't really, if you don't have a lot of machinery, you can't really borrow against that. But typically, if you're a high capex business, then you can borrow against the asset. Borrowing against asset is a good thing. It's something that allows you to make sure that if there's an issue, people will get the money back through the asset and not necessarily affect so much of the equity side.
Another one, what is the space of negotiation with investors? And the comment, I guess, that there is no negotiation if there is not a choice of potential investors.
That's to answer. Yeah, based on your interaction, I think that is part of the SIT. There's a whole part where we go over business planning and how to pitch your document, your business, and so negotiation. Mark Zuckerberg had a really strong negotiation standpoint, and I've met many investors or founders who had really very little negotiation power. So it's hard to judge.
What are the changes in fundraising approach during pandemic season and after its end, and how do you create a structure that is crisis-proof?
So that's a very good question. So during pandemic times like this, VCs investors will look at how is your business weathered, and if it's great, it'll be easier for you. If it's not doing well, then you'll have to explain how you're ready if this will last. And regarding crisis proof, the big thing that people are looking at right now is your cash reserve. So typically, I think I saw a number that on average, startups had about 28 days of cash reserve over, I think, a few thousand startups. I think it was, or a few hundred startups. It was a survey that was done early in March, or I think it's actually in January. And so that's not a lot. If you only have 1 month of cash on hand to pay your expenses, essentially a month into it or 3 months into it, your company does not exist. So you really have to take a look at how much cash you need to have on hand. And certainly cash is investment, and investment is taking away from your ownership, but that's an important element. Um, as you've seen in the earlier slides that I was showing, of the second biggest reasons companies fail is because they ran out of cash. I really encourage you to think deeply about how much cash you need and how much cash you have. And so that's really some of the things that investors are looking at. And now the third element to these two questions is right now, if you're VC, you're really worried about your portfolio, so you're going to spend time working with them. The uncertainty is going to guide your approach. So in most cases, maybe an investment they would have done now, they might postpone it just because they're quite busy with their current portfolio and closing deals that they had negotiated earlier. So, but you have to talk to VCs around you. Raising money is not a process that you just send your pitch and then a month later you've got the money in your bank account. No, you have to prepare it way ahead of time. You have to talk to VCs perhaps 6 months before you start fundraising, develop a relationship with them, get accustomed to what they look for, etc. And then at some point, once you feel like you've got enough VCs aligned and saying, "Yeah, I'm interested to hear more. I'm looking for your type of company," then you can start saying, "Okay, now we're running the clock. Maybe 3 months or 5 months from now, we'll have the money into the account."
Uh, I have a question in the chat that I think it's a quicker one, which is why are later investors more senior?
So essentially, the later investors are more senior because the later in life your company. So part of this is going to be addressed in the valuation, so I don't want to get into too much of a long explanation. But essentially, the later your stage, the bigger your company, and so the lower the return of the investor. And so, because they're getting a lower return, they want something in exchange. In exchange is priority repayment. That's a short story.
So we'll learn more about that in the next webinars. The next one is how does revenue-based financing work and whether it's better or a worse alternative to equity investment or debt?
So that's both easy and complicated to answer. In the oil industry, for example, or in the mining industry, you have agreements with some investors who will say essentially, I'll invest in your business and I won't have equity, or I'll invest in this oil field or this this mine, and I won't have equity in the business. I'll just have a royalty. And that's a very, very standard way of proceeding in the minerals and resource intense business. In the consumer business, in the SaaS business, or other similar, it's a difficult thing to really have an opinion on because it really depends on what kind of structure you have. Is it a finite structure where they get repaid based on your revenue, a royalty, and then they get fully repaid, then they get another 20% or some return based on the number of years. So there's going to be considerations like this. Baby is just something with no end, which, for example, in the case of fundraising, when you're a VC and you're fundraising, sometimes the fundraiser will say, you know what, I don't pay me now, you'll pay me a percentage of your fees you'll pay me a percentage of your fees. So your fund will last 10 years and every year you'll have to pay a percentage of your fees. So that's something that's happened. Other than that, without really, it's hard to opine without really having technical insights. I would say that you really have to consider how long you're going to have to repay them, and how comfortable you are with someone getting repaid before anybody else. They're paid off of revenue. They're essentially paid for a debt investor. So that's really something you have to measure.
The next one, and I think you're going to answer that in the next webinars, what are the main points social entrepreneurs must keep in mind when doing financial projections on their business plan?
Actually, it's something that I will talk about in webinar number 3 about business planning. So I was a social entrepreneur. Impact was a feature or was the goal of my company, but essentially you're still selling a product. And so when you're looking at your business plan, and again, this is something that's 50 or 70 or 80% of webinar number 3. I encourage you to attend. When you look at your business plan, you're really thinking about scalability. If you scale your revenues, if you scale your profit, if you scale, then you're scaling your impact, because impact, and so you have to look at it that way. Impact isn't necessarily a product. People buy a product because there's a economic value proposition for them, or it brings a value to them in some sort of way. Impact is the feature or a feature of your product. And so I would say if you have an income statement, perhaps you have an impact statement, and you tie your impact statement to a number of products that you sell, etc. But we'll look at it a little bit later. I'm writing down this note because I think it's an important aspect.
I promise that I only have 2 more questions for you. Yeah. And the next one is that uncertainty in the markets affects fundraising, and how does this in turn affect your capital structuring?
I would say that, so that's a good question. I feel like part of that has been answered through one of the earlier questions. I will just say that right now there's a lot of grants, there's a lot of loans available that do bridge funding between rounds. And so as part of the COVID, there's a number of things that are being put in place to allow you to, through debt or debt type of investment, have faster access to money. Debt is money that you don't have, money that somebody lends to you and they want it back. And so you have to think about equity. And then when we think about equity, I've answered how VCs through an earlier question.
And last question for you, since we are almost close, we are already over time. How can our fundraising stand out in these unprecedented times of high demand for access to capital?
That's a great question, and the answer is quite simple. Let's set aside the business itself. I've talked about in this time of pandemic what makes what investors might look at in terms of why they would invest in you or not. Are you weathering or not the crisis? Are you doing better? Are you doing worse? What's your cash management policy? I would say that what makes you stand out is if you're ready, if you've got all the terms aligned, if you're professional in your documents, if you've done your research, if you know who you're going to be talking to, if you make that conversation easy. Standing out is not about creating new structure. Standing out is about being professional about the standards that are set up in the industry at this point. So I really encourage you here to do your research, talk to investors locally, understand how they build up their term sheet, etc. Make sure that you've got your documents in order for the data room. Make sure that you've got everything aligned so that an investor comes in and says, that's an easy investment. I would say that that would be the standing out as part of the fundraising process.
I think it's time to thank you a lot for this first webinar. For the participants, please, next week we'll have the webinar, the second step on Wednesday, June 3rd. And at the same time, thank you so much, Thomas. And you please don't forget to answer the survey that is now on your on your screen. Thank you, and hope to see you next week on Wednesday, June 3rd for step 2.
Thank you.